When I look at this market, I keep thinking the same strange thing. Whether we have slower growth or higher pricing is irrelevant. Since the weak spot isn't the headline, the stress always seems to locate the same place. The plumbing is the problem. No one pays attention to it until it becomes the only thing that counts. New York time is Wednesday, February 11th, and let me know in the comments which day and time you're viewing. Quick item before we get rolling. Please show your support for this type of analysis by leaving a comment and subscribing. Okay, let's talk about the point at which the market appears normal and then feels different. That's our future ledger, Anna. You've probably experienced the sensation of the steering wheel vibrating while you're driving. It was only a vibration that wasn't there yesterday, not a collision or a blown tire. Regime changes start like that, with a trimmer, not a siren. The awkward part comes next. Although most people are conditioned to focus on costs, the true narrative is frequently hidden beneath them. Financing, assurance, security, and agreement. Those words determine whether a drop becomes problematic, but they aren't really sexy. I therefore wish to construct something in the manner of a mechanic. Like someone who's trying to figure out why the engine is making that sound, not like a politician or a cheerleader. Because the smoke no longer surprises you once you comprehend the sound. You've probably noticed the pattern if you've been following markets for a while. Financial support and fear are two different things. Fear is a feeling. The funding is mechanical. Fear makes people rush to the exits. The building's realization that the doors are locked is funding. It generally goes like this. The textbook moment is the first step. Stocks sway. Risk off, they say. The assets we were trained to label safe are flooded with money. Yields decline. When step 2 hits, commentators grin and say, "See, the system works." The appearance of the bills is step 2. Transactions that must roll, margin calls, cash-required hedges, and collateral that must be posted. In the second level, people sell what they can rather than what they desire. Because the current system is based on leverage that is cloaked as efficiency, that is the whole game at the moment. Therefore, the leverage does not gracefully unwind as volatility spikes. It breaks. Liquidations are forced. A market becomes a fire drill as a result. The twist that most people overlook is this. In the event of a fire drill, the liquid assets, not the worst ones, are sold first. And that's how you can create an environment where yields climb along with anxiety. If you're living in an outdated textbook, that sounds outdated. In a world where bonds are used as collateral rather than as investments, however, it begins to make sense because bonds are what people sell when they urgently need money. I want you to stop now and give this some serious thought. If you've achieved success, tell others about it in the comments section to keep them inspired, because being correct once isn't enough to survive markets. It's about surviving the difficult times. Let's zoom out now. There is a lot of debt in our world. Home debt, business debt, and government debt. Additionally, a high debt load makes the system vulnerable. A slight change in rates no longer feels insignificant. It is similar to applying pressure to a bridge. Trucks can roll over the bridge all day long if it is sturdy and new. The same truck becomes a test if there are cracks in the bridge. Thus, the question is not whether rates will change. Rates fluctuate constantly. How much more can the system withstand before it begins to malfunction? Moreover, breaking anything does not portend the end of the world. It might be a careless auction, an abrupt repo gap, an increase in hedging expenses, or a strategy that was successful for years suddenly turning into a blender. There have been more indications of that than most people would like to acknowledge. Consumer delinquencies are rising and hovering at levels we haven't seen in a long time, according to recently released data. That headline isn't ominous. Since the consumer continues to be the main driver of this economy, that serves as a pressure gauge. Therefore, you don't have to foresee a crash when you observe more people missing payments. You simply must acknowledge that the cushion is thinner. Additionally, the system's ability to absorb shocks is compromised when the cushion is thinner. There's a trap here now. When delinquencies increase, some people say, recession, maybe. However, it's not so easy. Many households had previously locked in low fixed rates. Many consumers with higher incomes still have money to spend. Additionally, the job market may remain robust for longer than pessimists anticipate. This is my counter-argument. An increase in delinquencies does not always indicate a collapse. Fragility is guaranteed. It ensures that the subsequent shock will travel more quickly. It ensures that politics will become more prominent. Additionally, It ensures that the central planners will be less tolerant to suffering. That's a significant difference. Behavior is altered by fragility even before anything breaks, because policymakers tend to favor rescue sooner when they perceive fragility. And the sooner, the better. Because there isn't a lot of dramatic speech involved in the modern rescue. A series of tiny valves are being opened, the message to large balance sheets is subdued. The institution now goes by a different name. It's a change to the criteria for quality collateral. It's a pledge that if the wheels start turning, liquidity will appear. The speed at which the system reaches for those tools has previously been shown. Recently, there have been instances in the market where short-term funding stress manifested itself so strongly that official backstops were employed in a way that forced traders to pay attention. That's not a prophecy once more. That's a hint. Now, since this is where people undervalue the contagion story, I want to take you abroad for a moment. Japan is important, but not because it is the entire world. Japan is significant because it is situated inside the low-rate era's psychological underpinnings. See, you can run high debt forever. Low yields, stable currency, quiet markets was the standard for decades until reality began to shift. It raises a question when Japanese yields fluctuate in a way that puts pressure on the currency. Which do you support, the currency or the bond market? Although that question seems scholarly, it isn't. Because simultaneously defending both frequently necessitates printing, the one thing that markets detest the most. That's clear. Let me be careful now. Japan possesses tools. Japan has savings at home. The structure of Japan differs from that of several former superpowers. Therefore, I'm not claiming that Argentina is Japan. I'm saying that when the world's most regulated bond market begins to appear less regulated, it alters how risk is valued elsewhere. And this is why it is important to the U.S. The collateral base for international finance is the U.S. bond market. Therefore, if the world system has a lot of U.S. paper and tension increases, it seems sense that they would sell that paper to raise money, not because they despise America, but because they need the money. You may see the strange sequence we discussed because of this. Fear causes bond yields to drop momentarily, then sell off, and then increase again. Additionally, because higher rates tighten circumstances, the clock starts to tick when yields rise in dread. Growth is slowed by tighter circumstances. Revenues suffer from slower growth. Deficits grow as revenues decline. More issuance results from larger deficits. Also, when there is additional issuance, the market wonders what the price is. You're up to date now, and narratives shatter at loops. I can hear the pushback already. Hurry up. Won't the largest institutions simply intervene and bring things under control if something breaks? Yes, occasionally. However, stability and safety are not synonymous. It's more like pushing your knee beneath a wobbly table to keep it from toppling over. The table isn't being fixed by you. All you're doing is shifting the weight. And the weight is enormous at the moment. Let me demonstrate why plumbing is more important than atmosphere. Consider a stadium with space for 100,000 people. Most of them are sitting on an average day. You are able to use the aisles. Snacks are available. There is a restroom. It seems spacious. However, the same stadium feels crowded the moment everyone stands up at once. Additionally, it becomes a bottleneck if everyone attempts to exit by the same gate. The treasury market is that. When only a small portion of participants need to trade urgently, it appears limitless. When everyone needs money and collateral at the same time, it appears to be very limited. Because of this, the market may appear to be quiet when it isn't. Here's a really dull explanation on why calm may change quickly. Harvesting small spreads between closely similar assets is the goal of many smart money techniques. Consider it similar to picking up coins. The walk won't be worthwhile if you only pick up 1 penny at a time. They therefore gather a large number of pennies at once. They also borrow in order to collect a large number of pennies at once. It's math, not morality. The transaction that attempts to close the difference between cash treasuries and treasury futures is among the most well-known examples. In a peaceful setting, it would appear to be free lunch. The free lunch becomes a margin call under pressure. This issue has long been a topic of open discussion among researchers and regulators. And this is the crucial detail. Those exchanges don't end amicably when they do. They relax in a rush. Because risk systems ask about your collateral rather than your emotions. Thus, you are compelled to sell your most liquid possession. It's sellable, not because it's horrible. That's how you have a day where rates continue to rise while equities are red and there's a lot of concern. It isn't contradictory. It's the deleveraging process. Now consider the impact that has on policymakers. Bond prices are not the only thing impacted if yields rise during a period of anxiety. Mortgage rates are affected. It affects corporate financing. It affects the cost of government funding. Every spreadsheet in the system that relies on steady collateral is affected. As a result, the response is prompt, but it is typically influenced by limitations. Officials can't just make a huge, conspicuous rescue without incurring pressure if inflation is still a problem. Large programs are questioned when politics are heated. The appearance matters if the public is upset. Therefore, multi-layer rescues are more common. A facility where collateral of one type is exchanged for another. A modification that increases balance sheet's capacity to hold paper. The backstop is presented as technical, a statement intended to soothe the masses. You will see variations of this that you have already seen. This is where individuals now make yet another error. They think it's easy to figure out who purchases Treasury securities. It isn't. Numerous purchasers exist, and their behaviors vary. When balance sheets and rules permit, banks make purchases. Pensions make long-term purchases as necessary. When they are able to match liabilities, insurers purchase. When money market funds can safely store cash, they purchase it. When the dollar transaction makes sense, foreign buyers purchase. And through all of it, households make indirect purchases. Therefore, demand does not vanish when the market is under duress. It changes and becomes sensitive to pricing. Auctions are a major indicator because of this. A soft auction is more than just a news story. Now add the human element. The market is saying, "I'll take it, but not at that price." Politicians' tolerance shifts as consumer stress increases. Additionally, the percentage of balances that are falling into delinquency has been gradually increasing according to recently published household credit data. Once more, I'm not predicting a crash tomorrow. The shock absorbers aren't as thick, I'm suggesting. Additionally, the system gets jittery when the shock absorbers are thin. Let's now discuss the argument that you have most likely heard 1,000 times. The days of inflation are over. No, inflation never goes away. What people miss is this. Both inflation and deflation can be problematic in a world with high levels of debt. Debts become heavier in actual terms due to deflation. Cash flow is squeezed. It increases the likelihood of defaults. Purchasing power is diminished by inflation. If yields aren't capped, it puts pressure on them. Savers are forced to take chances in order to remain motionless. Therefore, you finish up where you started, regardless of the course you choose. Emphasize your commitments. Additionally, markets begin to care more about collateral that is outside of commitments when promises are strained. That's why gold continues coming up in these discussions, not as a panacea, but rather as a way out of issuer risk. Here's a subtlety that keeps people from experiencing emotional breakdown. Gold is not a straight-line commodity. Because individuals sell anything they can to raise money, gold may decline when everything else does. While the long-term thesis remains sound, gold can move sideways for months. Even when everyone is yelling for gold to increase, it can fall. Therefore, while considering gold, think in regimes rather than days. You're hedging against what risk? Varied tools for varied purposes include currency leaks, policy responses, geopolitical settlements, and loss of confidence. Now, central bank activity is a new piece of context that is important in this case. According to recent public reports on the gold market, demand was exceptionally high overall in value terms, and central banks continued to be consistent buyers even after significant price fluctuations. That is significant because it implies motivation. Charts are pursued by short-term traders. Reserve managers seek out opportunities for flexibility. This brings us to the term that everyone uses incorrectly, dollarization. A dollar crash is not necessary. The dollar may remain dominant but become less exclusive as a result. More bilateral settlements, a little altered reserve composition, and trade corridors utilizing other units. Here's why that's important. Pricing can change at the margin even if automatic demand is somewhat reduced, and yields are fixed at the margin. Let's relate this to your life now. Stocks may rise in a market where households are feeling pressured. It's not insane. A split-screen reality results when asset values are supported by liquidity while costs increase. What exactly are you measuring in terms of cash or purchasing power then? People continue to gravitate back toward actual assets because of this. Stabilizing the measuring stick is their goal. Since the term technology accelerant is more than simply a catchphrase, let's now discuss it. AI is developing far more quickly than most organizations can keep up with, and that leads to a funding issue that no one likes to discuss. Governments depend on widespread involvement: income taxes, consumption taxes, and payroll taxes. The tax base may become unbalanced if technology alters employment trends, compresses certain earnings, or moves the location of profits. Additionally, since the interest bill doesn't care, unequal revenue is risky when there is debt. You find yourself in this peculiar circumstance. The same companies that are constructing the future are also increasing the strain on the outdated revenue model. The snake is consuming its own tail. Good for you if something sounds dramatic. That's what makes it significant. Now stop and consider what that means. Policymakers are more likely to resort to financial repression if the revenue base becomes less solid. Yields are capped. The bond markets are supported by them. They pressure savers to invest in riskier assets. To help with the cleanup, they promote inflation. Thus, we return to the central tension. The decision in the next stress event will most likely be to allow purchasing power to absorb the harm and preserve the bond market in nominal terms. It isn't a political viewpoint. That serves as a motivator. Because a disturbance in the bond market is obvious and happens instantly, it is undeniable that purchasing power is slowly evaporating. The route of least resistance in a world with a lot of debt is typically mild to moderate devaluation over time, and the market prices that slowly, then suddenly. This is what I'm saying before someone clips this and declares, "I'm predicting hyperinflation." What role does cryptocurrency play in this then? It's lazy to lump stable currencies and cryptocurrency together. They address various issues. The price of Bitcoin frequently resembles a high beta liquidity indicator. When liquidity becomes constrained, it may drop sharply. It can rip when liquidity comes back. Worship is not that. That is an observation. In this way, it can serve as a warning sign rather than a promise of safety. Stablecoins are now distinct. A settlement rail is what they are. They are a means of swiftly transferring money via the internet. That is helpful for persons who live in areas with unreliable banking. However, stable currencies still raise the trust issue. Who gives it out? How is it supported? The reserves are where? What takes place when you're under stress? Naturally, you would ask those questions if you were living through a currency crisis. This is the skeptical viewpoint that isn't given enough consideration. The basic debt math remains same, even if stable currencies increase demand for government bonds. It doesn't address the entire issue, but it might be helpful in the short term. It is not a reset, it is a patch. All of knowledge is meaningless if you can't translate it into action, so let's get down to business. Binary thinking is the most common error people make in situations like these. One asset, one wager, one flawless prediction, all in, all out. The market disregards your desire for certainty, which is how people are destroyed. It is concerned with your capacity to endure instability. This is a healthy structure then. Think in layers. Cash flow is the first layer. You can wait if your cash flow is steady. You are compelled to make choices if your financial flow is unstable. Leverage is layer 2. Leverage transforms everyday actions into pivotal moments. Treat leverage as though it were fire. Never trusted, kept under control, and contained. Diversification by risk type, not by ticker, is layer 3. It is not diversity to own 10 items that are all dependent on the same funding source. What breaks this, you ask? What makes it through that? The fourth layer is rebalancing. Rebalancing isn't attractive. It isn't a meme. It's a discipline that makes you buy a bit of what's cheap and sell a little of what's pricey. People are kept alive by that discipline. The fifth layer is timeline humility. You can't remain obstinate as long as markets can remain irrational. Therefore, create a plan that doesn't depend on precise timing. Let me now offer you some indications that I'm keeping an eye on, since this is where folks may truly maintain their grounding. First, do yields drop and remain low, or do they swiftly rise again when risk strikes? Secondly, what are the actions of funding markets? Not funding headlines or locations where short-term funds become costly. Third, how does the currency react to increased stress? Does it function as a warning light or as a shock absorber? Fourth, do commodity inputs remain stable despite growth concerns that may indicate a fundamental change in costs? Fifth, does the focus shift from exposure to control, collateral, delivery, or custody? Those are signs of trust. None of these, however, are assurances. Simply put, they are pressure gauges. Additionally, you are less shocked if you monitor pressure gauges rather than memes. Let's now go over a scenario so you can experience it. It's a movie trailer, not a forecast. Consider a week in which a number of little events occur simultaneously. An auction is not as strong as anticipated. A pair of currencies moves more than normal. A few large funds cut risk at the same time. The volatility increases. The first day appears to be typical. Bonds are up, stocks are down. Classic, everyone says. It feels strange on the second day. Bonds no longer help, but stocks are down again. Yields cease to decline. Spreads on credit get wider. The language shifts on the third day. Instead of exchanging viewpoints, people begin to inquire about settlement, margin, and who is compelled to sell. The most liquid collateral is struck at that point. At such point, rates may increase notwithstanding the decline in risky assets. At that point, officials realize they must act quickly to prevent the collateral basis from collapsing. Thus, you receive the answer. Perhaps it is presented as transitory, perhaps it is presented as technical. Although it may be presented as targeted, it's actually liquidity. Additionally, assets can recover strongly once liquidity is available. The nominal tide climbed, but not because the economy miraculously recovered. People are whipsawed for this reason. They play on people's fears. After the rescue, they are forced to watch prices plummet without them. What is the proper course of action? Guessing the precise day is not the goal. The goal is to prevent having to sell at the worst possible time. That's all. The edge is that. This explains why the topic of actual assets like gold continues coming up. Not because winning gold is a given, because gold exposes you in a new way. It is independent of corporate profits. A central bank guaranteeing stability is not necessary. Trust and scarcity are key factors, and when the system seems overburdened, those factors become even more significant. I have an important question for you now. Which do you believe will cause the next major shock, the currency or the bond market? Leave your response in the comments section. Tell me the day and time you're watching from once more. RJ, please subscribe and leave a comment if you wish to assist the anti-copycat campaign. Future Ledger Anna. Okay, final point. Everything we discussed today was done so for discussion and enlightenment. I'm not advising you on personal finances. Your objectives, financial condition, risk tolerance, and other details are unknown to me. Use this as a lens then. Complete your own assignments. Additionally, before making important decisions, consult a certified specialist if necessary.